Welcome to the BS and Barron's Report for the week of October 3rd, 2012. I'm your host, Craig Slayen. Each week, we review actual articles in the number one most respected weekly publication in the financial industry, Barron's Magazine, and profile the biggest, most noteworthy illusions they are publishing. Here they are. Today, we're looking at the magazine that was on the newsstands exactly 12 months ago this week, the October 3rd edition. And the focus today is on illusion number one, does stock picking work? So let's see how well Barron's research worked. In this issue, Barron's profiles Hewlett Packard Company, the world's leading PC manufacturer. The title of their article, Time to Buy HP? Barron's writes, it's almost a license to print money with a laser jet. Hewlett Packard stock has fallen so low that it may have nowhere to go but up. They write, trading at less than 5 times projected earnings for 2012, the stock is the most inexpensive among all technology names. So let's see how well stock picking works. The article quotes Todd Lowenstein from Highmark Capital Management. Now, the firm Todd works for, Highmark, it's no small investment firm. They have $12.3 billion of assets under management. And Todd himself is no slouch. 18 years of experience, JP Morgan Investment Banking, KPMG Pete Marwick CPA, and an MBA from UCLA. And he runs the Highmark Value Fund, which is a $345 million fund. So let's look at the numbers. So first of all, with $345 million of assets under management, and them reporting an expense ratio of 1.27%, Highmark Value's fund is bringing in $4.3 million in fees each year that they can spend on the best and the brightest to help pick stocks for them. This doesn't even include the upload fee Highmark charges some of its investors, which is up to 5.5%. So where does Lowenstein think HP is headed? Great risk-reward profile for investors, worth $47 a share. So where are we 12 months after this article was on the newsstand? $14.91? Down 32.8%? Wow. If you had bought the S&P index that same week, you would have been up 31.9%. So let's look at that in a different way. If you had invested $100,000 in HP, it would be worth $67,000  12 months later. If you had invested that same $100,000 in the S&P 500 index fund during that same time period, it would have been worth $131,000. So investing in HP versus the large cap S&P 500 index, you would have made a $64,000 mistake. So, does stock picking work? I don't know. You tell me. Remember, it does not matter how big your mutual fund company is, or how much they spend on research, or how well a portfolio manager has done in the past. Consistently picking baskets of stocks year over year is almost impossible. And I'm not saying that your funds won't have a great year every so often. What I'm saying is that it is more due to luck than the skill of the fund managers, and the likelihood that they're going to repeat is extremely low. So that's it for today's edition of the BS and Barron's Report. These are the 5 industry illusions we will be reviewing each day to enhance your knowledge in investments. Remember to watch out for our next report, because if you can't see the BS, you're going to continue to step in it.